Hi there. In this video, we will start talking about the last part in the consolidation, and I hope you still remember the previous three chapters. In the second chapter, we talked about consolidation between the parent and a subsidiary, where the parent is buying 100% of the subsidiary, and the book value is equal to the fair market value. So we didn't have non-controlling interest, and we didn't have any goodwill. But then in the third chapter, we start talking about the parent company is buying a portion from the subsidiary company. And here we see NCI, but the book value was equal to the fair market value. So we didn't have any goodwill or increase in the prices. In the fourth chapter, we talked about the parent company is buying 100% of the subsidiary, where we see the fair value is higher than the book value, and there we used to get goodwill and increase in the prices. And today we will start talking about a parent company is buying a controlling interest in a subsidiary company, and the fair market value is higher than the book value. So with this in mind, let us go through the presentation and then we go through some exercises. So I hope you still remember this chart from the prior three chapters. 2 and 4 are talking about 100% of ownership by the parent company. But in chapter 2, we had the book value equal to the fair market value. And in chapter 4, we have the fair market value higher than the book value. And because of that, we see goodwill. And in chapter 3 and 5, we see ownership is controlling, but not 100%. It's something between 51% and 99%. And in chapter 3, we see the book value equal to the fair market value of the investment. But in chapter 5, we see the fair market value of the investment higher. And because of that, we see some goodwill. So what are the journal entries we need to make here? First, for the investment, then for the consolidation. For the investment, we need to do the same journal entry that we did it in the prior chapters, where we debit investment in subsidiary company, then we credit cash or bonds or preferred stock. And I hope you still remember this journal from the prior chapters. However, when we come to the distribution of the net income, we have the same accounts. We debit investment credit income, but the amount we put here, it's for the parent portion. It means if the subsidiary company is making $100 net income and the parent is owning 80%, so the parent will take $80 and the NCI will take $20. So here we have the same accounts, but the amount will be different. The same thing for the loss. If the subsidiary company made loss, we debit income, credit investment, but we put also the portion that the parent should take from the loss. The same thing for the dividends. We debit cash, credit investment by the parent portion of the dividends. So this is the key point in chapter 5, that every journal entry should consider only the parent portion and the other one goes to the NCI account. How about the amortization of the difference? If the fair value is higher than the book value, we amortize the difference over the years. We debit income, credit investment. And now we come to the consolidation. In the consolidation, we do similar accounts. We debit common stock, we debit retained earnings, we credit investment. So those three accounts, we have used them many times before in the prior chapters, but I say in this chapter, we add a new account called NCI in the net assets. What do we mean by net assets? I mean total assets minus total liabilities. And here for the investment, we put the parent portion. So whatever the parent paid for the investment will go here, the other amount will go for NCI. And for the differences, we debit inventory, building, depreciable asset, any increase between the fair value and the book value on those assets. And then we credit investment by the parent portion, NCI, and the difference between the debit and the credit accounts will go to goodwill. So in all the exercises that we will get in this chapter, we will not find the goodwill. We have to calculate the goodwill. And you need to keep this in mind. So now let us jump to the first exercise. And I'm going to do them in parallels. So let me make it here. So first here is the exercise. Second, here is the journal entries. Yep, here is the presentation. And now let us share the screen. Yep, so here you can see the exercise along with my presentation. What do we see here? First, we have one company, Puma, purchased 70% of subsidiary company called Sunny and paid $155,000. And the subsidiary company has outstanding stock 131 and retained earnings. The subsidiary company made net income 36,600, comprehensive income, which means ordinary net income plus extraordinary transactions, and paid dividends 31. So the income, the comprehensive income, and the dividends is for the parent, which will take 70%, and the NCI, which will take 30%. So to do my calculation for the equity account, let us get the first one. So let me show it to you here. So here I have the net income, 36,600. I multiplied by the 70% to get the parent portion. And then I do the same for the comprehensive income. The comprehensive income is 42,600 and the net income 36. So we subtract them to get the difference, which is 6,000. And then multiply the 6,000 by 70% to get the parent portion in the extraordinary transaction. And the last one is the dividends. The dividends here in our example is 31,600 multiplied by 70% to get the parent portion. So in my journal entry that I need to do it here, I care about those three amounts only. How can we make it? We debit investment credit cash by this amount, 155,400. Then we make the next one for the distribution of income, the next one for the distribution of comprehensive income, the last one, the distribution of dividends. And this would be the answer for the first exercise. So please remember how to do the journal entries for controlling interest, which is between 51 and 99. Now let us look at another example. Here we have two companies. Prism is the parent, Sweet is the subsidiary company, and the parent purchased 75% from the subsidiary. And the NCI has 18,600 fair value. So what do we need to do? We need to do the consolidation entries. In exercise 1, I did the investment entries, but here we do the consolidation where we debit common stock, where we debit retained earnings, and then we credit investment, and we try to balance off the difference. And here I put the difference before we start to see how much is the difference between the fair value and the book value. So here, if we look, the subsidiary company here has cash fair value 5 and book value 5. So there is no difference. The same thing for the receivables. But when we come to the building and equipment, we see 5,000 difference. And then we see here 20,000 difference. When we go down to the liabilities, there is no difference. So we need to keep those differences in mind because we have to do consolidation for them. So how can I do the consolidation here? We take the common stock and the retained earnings, and we add them together. So we get a total of 37,000. From the 37,000, we give 75% for the parent, 25% for the NCI, and here for the parent, we get 27,750. For the NCI, we get 9,250. And here you see, we debit common stock by 10, debit retained earnings 27, credit investment by 27,750, and credit NCI by 9,250. This is the first journal entry for consolidation. The second one is for the differences here. So we debit inventory, debit building, but then we credit investment in suite company by 18,750. And if we add 27,750 and 18,750, we will get the total here of the investment 43,400. And here for the NCI, yeah, as we said here, it's 18,600. And here we debit credit, sorry, the NCI 600 to 250. I'm sorry here. For these ones, the 18,750 and the 6,250 is not the addition here, but we take the total 25 and then multiply by 75%, we get the investment, and then multiply 25,000, we get the NCI. But you might wonder, how do I get the 43? We get the total amount of investment, and then we should add net income and then subtract dividends to get 43,400. But you might wonder, where can I get the net income and the dividends? They are not given here, and I'm not asking you to calculate. But I'm trying to explain how can I get this balance from the journal entries. We get the investment plus net income minus dividends. Now let us jump to exercise 3, which is similar to the previous one, because we need to do consolidation entries, which is similar to these two. However, here we have different scenario. The parent company purchased 60%, not 75%. And the parent company here made, the subsidiary company made net income for 3 years and dividends for 3 years. However, in the requirement of the exercise, it says I need to do the consolidation on January 1st, which means on the day of the acquisition, which means although I gave you all this information, we don't need it in the answer. So net income and dividends for 3 years can be used later, but not to answer this exercise. And here, the common stock for the subsidiary during the day of the acquisition was 250. The retained earnings 150, and this is what I'm going to put in my debit account. The fair value of the non-controlling interest is 185. The land has a difference between 27 book value and 35. So we have 7,500 difference between the fair value and the book value. And for the equipment, we have 40,000 difference between the market value and the book value. And here we need to do the consolidation. So to do the consolidation, first we take the total common stock and shareholders' equity. Here, 400 multiplied by 60, because we own 60, we get 240. And then multiplied by 40, we get 160, which is the NCR. And we do the journal entry here. So we debit common stock, 250, debit retained earnings, 150, credit investment, 240, and credit 160 NCR. However, if you see here, he said, the NCI is 185. You can see this one here. But here I have 160. So the difference between them is 25,000, which I will put it there. Also here we have 240, but here we have 277. So we have 37,500 difference. I will put it in the next journal. And here is the next journal. We credit investment by 37,500. We credit NCI by 25, by getting the difference here between the book value and the fair value. How can we allocate this difference? We say for the land, there is 7,500. For the equipment, there is 40,000. The difference between those two accounts and those two is 15. I put it into the patent. Why don't we put it in the goodwill? Because it says here, we need to put it in the patents account. So now we made the journal for the third exercise, and now let us jump to the fourth one. In the fourth one here, I see a parent company is acquiring 80% of the subsidiary company. And here we have the trial balance at the end of the first year from the acquisition. In the parent company here, we can see all the debits and the credits in the trial balance. And here we see the same thing for the subsidiary. And there is depreciation, accumulated depreciation during the day of the acquisition, 52,000. Now, how can I make the journal entries for consolidation at the end of the first year? First, we take here the common stock and the retained earnings of the subsidiary, as we did in the previous example. So we should say debit common stock, debit retained earnings by those amounts. But also we need to debit the income from the subsidiary company. And then we need to credit the dividends from subsidiary company and credit the investment in subsidiary company. And then we need to take the net assets multiplied by 20% to get the NCI. So let us go through it here. 81 common stock, 31 retained earnings, income 28,800, NCI, and I will show you now how we calculate the NCI, but let me go to dividends declared 14,000, and here investment 106. And now we need to know how do we get the 7,200 and how do we get the 26,640. First of all, if I take 28,800, which is this one, and divide it by 80% to get the total amount of net income, we get 36,000. If you take 36, multiply it by 20% to get the NCI, we get 7,200, which I put it here. How do we get the NCI here, 26,640? You need to read it here. It says during that date, the fair value of NCI 20% of the book value of this one. So how do we get it? We get first 106, which is the total current assets. We get 314, which is the depreciable assets. This will give me total assets. Then we subtract liabilities from the assets, so minus 65 current liability, minus 65 accumulated depreciation, minus 27 current liability, minus 194 800, which is the long-term liability. If I make the calculation here, we get 133,200. We call it net assets. And this is what it says here. How much is the NCI in the net assets? It's 20%. So I take this one, multiply it by 20%, we get 26,640. So now I did the first journal entry of consolidation. How can I do the second one? It's given here, 52. So we debit accumulated depreciation, credit depreciable asset by 50. Now I need to jump here to the second sheet to do the consolidation. If you look here in the second sheet, we don't see any of those accounts here in the consolidation. What we can see is income from Sama company, and this is here. It's income from Sama company debit by 28,800 and NCI in the net income 7,200. And this is what I'm going to put it here. So we have 28,800 the income, and we have 7,200, it's the NCI, and then we start to add our accounts. So here we see that we have total sales, I add those two, then I add depreciation expense, then other expenses. And here the income should be 0 because the balance of the income is usually credit. When you adjust the debit, it should get 0. And here debit by minus because I should subtract it from the total net income to get the income for the parent company. How can I do the consolidation for the retained earnings? I take the consolidation here from the trial balance. So you can see here, the retained earnings 230. And here we have the dividends declared 58. And we have the net income 108,800. And this is what we see here. So we have 230 beginning plus net income minus dividends equal ending balance. How can I get it for the subsidiary? It's the same. We start by 31,000, then plus net income, which is the net income for the parent 28,800 and subsidiary 7,200. If you add them, you get 36. Minus dividends, which is given here, 14,800, we get the ending balance. Then we need to close off the accounts for the subsidiary. So here the retained earnings 31, it's debit. From where I get it, it's from here. Here, you see, retained earnings debit 31. So I put it here debit, okay? Net income debit, because I also, if you put, remember here, if you add 28,800 and 7,200, both of them are debit for 36,000. So here I put 36,000, and then I have dividends 14,800, and when I add, I get the 28,800. And this is the answer for the retained earnings. The next one is the balance sheet, which you see it here. And here we say, if we don't have any adjustment, we add the two numbers together. And if you remember, we made the depreciation here. So we put 52 credit and 52 accumulated depreciation debit. And then we make the journal entry here for the equity accounts. And now we can add, if I add current and current, I put the total here. The same thing, debit, debit, and credit. So this one plus, minus. And here we have all of them offset. So 157 plus 65 minus 52, we get 170. And then the investment will be 0 because we offset the investment here. It's debit, I make it credit. From where I get this credit, I get it from here. Here, the investment credit by 106. Okay. And then I make the equity accounts and I do the NCI and I get the two sides equal. So this is what we learned in exercise 4. And now let us jump to the last one, which is talking also about consolidating entries and consolidation of balance sheet only. So we don't need to worry about income statement or retained earnings. And here the acquisition is 90%. So the NCI is 10%. And here the NCI has a value of 31,900. However, we don't see here any income or dividends, which will make our life easy. So here for this one, the consolidation, we do debit by common stock 74, retained earnings 215, and then we credit the investment by 278,100 and credit NCI 30,900, which is given here. And the difference between them should go to land. From where I learned it, it's here. You see, it's assigned to land. So this tells you that for the difference, you cannot put it in the goodwill. It has to go to land. And then there is an intra-company accounts like here, 12,000 plus 1,300. The total will be 13,300. And we debit accounts, payable, credit, accounts receivable to close them off. And now we need to do the consolidation for the balance sheet, which we take it from those journal entries. the equity and the intracompany account. So here we put the intracompany account, and here we put the equity account, and then we start adding. We get here 1,301,000 for both sides. I hope you find these exercises useful to show you how we make a consolidation between a parent company that owns controlling interest and the subsidiary, and creating the new account for the NCI. I hope you find this short video useful to do the assignment, and if you need anything, please let me know. Thank you. Bye-bye.